Episode 11, the compensated price and affordability. We are often told that since the banking system can always create and lend more money into the economy, there can be no inherent shortage of consumer credits. But what if that isn't exactly true? According to the social credit proposals of Major C.H. Douglas, not to be confused with Chinese social credit, both consumers and the economy as a whole require more consumer credits, but in the form of additional income or cost liquidating purchasing power rather than debt. Under social credit, the National Credit Authority would create and distribute sufficient supplementary credit, free of debt or any other costs, to ensure that the flow of consumer incomes will match the flow of costs, and hence the prices of consumer goods and services as they come onto the market. These consumer credits are simply ledger entries that are backed by the existence of physical goods and services for which insufficient income has been distributed through the usual channels, wages, salaries and dividends, in the normal course of production. The two means that Douglas proposed for injecting this debt-free credit are A compensatory price mechanism which would lower all retail prices so that they reflect the average natural cost of production as compared with financial costs, and B, national dividend payments distributed on a periodic basis to each citizen. Douglas observed that on a physical level or from a realistic perspective, the true cost of producing anything was the consumption of all of the matter and the energy that was necessary to bring it into being. The true cost of manufacturing a car would be the metal, plastic, labour, technology, etc. that was consumed or used up in the process of making the car. Now a financial figure can be put on all of those real or natural costs, and if the financial system accurately reflected reality, total financial costs should never exceed the natural costs. Unfortunately, under existing accountancy rules, financial costs are artificially inflated by capital loan repayments or similar financial charges. Payments which do not correspond to any consumption whatsoever and for which, or on account of which, consumers have received no purchasing power. By measuring the degree to which total production costs in an economy exceed the corresponding natural costs, as determined by the consumption-production ratio, we can determine the degree to which financial costs should be reduced, on average, so as to ensure that consumers are only charged with the true or natural cost of production. If the average CP ratio is 4/5, then retail prices should be reduced by 20% across the board. This would increase consumer purchasing power indirectly by making goods cheaper. The National Credit Authority would make up the difference to the retailer with a corresponding infusion of debt-free credit so that he could cover all of his financial costs. This injection would come into play only if and when a consumer made a purchase, so there is no danger that it could contribute to inflating the value of fixed assets. Episode 3, Money and the Economy. We are often told that money and the financial system are merely neutral arbiters that have no impact whatsoever on economic behaviour and outcomes. But what if this isn't true? According to the social credit analysis of Major C.H. Douglas, not to be confused with Chinese social credit, money and the financial system are anything but neutral. In reality, our current financial system is the culprit that is responsible for most of our economic problems. Why is this so? Let us begin with the observation that there are two distinct dimensions to economic life. There is, on the one hand, the physical economy, the economy of raw materials, of labour, of factories and machines, and of technological know-how. This is the economy's hardware. On the other hand, there is what we might refer to as the financial economy, the economy of costs and prices, of money and purchasing power, of inflation and deflation, of debts and interest payments, of taxation, of the stock and bond markets, of derivatives, and of periodic crises. This is a large part of the economy's software. Whereas the physical economy involves the resources possessed by a given country or region and is governed by natural laws, such as the laws of physics, the financial economy is largely an artificial construct, something that operates according to human conventions, something that can be changed to suit whatever policy objective we wish. The basic contention of social credit is that our economies fail to live up to their potential because our financial software is not properly designed. It does not accurately correspond to, does not mirror our physical hardware. Instead, it systematically underestimates our wealth and makes it appear that we are poorer than we actually are. When it comes to our capacity to produce new wealth, the current system does not automatically supply us with sufficient money to ensure that. Given the availability of the necessary resources, all of our needs for useful production can be met. There is an artificial lack of producer credit. When it comes to our capacity to consume the wealth we produce, the current system does not automatically provide us with sufficient income to buy back in full all that we produce and to thereby liquidate all of the relevant costs of production. There is an artificial lack of consumer credit. The artificial limits which the financial software imposes on the physical hardware put finance in the driver's seat, ahead of the real economy. Finance steers the real economy to suit its own objectives. Money is master, and the real economy is the servant. The only way to re-establish the correct relationship where the real economy is master, and money is but a servant, is to make the financial system an honest system, which accurately reflects the facts of the physical economy. Liberated from any artificial constraints, the physical hardware would be free to provide us with all that we need, while calling on the least amount of labour and of resource consumption. Episode 10, A National Monetary Policy. We are often told that the financial system is like the weather, that it is a natural part of life that cannot be changed. But what if that isn't true? According to the social credit proposals of Major C.H. Douglas, not to be confused with Chinese social credit, the financial system is a man-made system that can be re-engineered to suit whatever policy objective we wish. If we want the financial system to be optimally functional in facilitating the fulfillment of the true purpose of economic association, the delivery of the goods and services which people need to survive and flourish with the least amount of labour and resource consumption, then we have to ensure that the financial system will be an honest system. An honest financial system would be one that is designed in such a way that it provides us with an accurate picture of both our real and potential wealth. It would ensure that there is always enough money in the form of producer credits to catalyse useful production, i.e. production that meets some legitimate need or desire, and enough money in the form of consumer incomes or cost-liquidating consumer credits to buy all the consumer goods and services that are coming on the market and to liquidate their corresponding cost of production. Money must cease to be a commodity that is kept in short supply and become instead a neutral tool that accurately represents our capacity to produce as well as our ability to consume. In order to effect this change, which would duly subordinate money to real things and to real human needs, Douglas proposed that each country should establish a national credit authority. Its purpose would be to regulate a nation's financial system in view of what is the correct financial policy, finance as a mere servant of real economic possibilities and priorities. This national credit authority would be an independent state body of statistical experts that would be responsible to the community through its parliament or Congress. It would have no power over the individual decisions of economic actors, such as governments, businesses, including private banks, and consumers, provided that all of these were operating within the functional necessities of the system. With regard to the economy's production function, the National Credit Authority would ensure that, whenever there is, on the one hand, legitimate needs for various goods and services, and, on the other, the economic resources, i.e. the raw materials, labour, machinery, etc. To meet those needs, financial credit, in the form of loans to producers, will always be readily available. No longer must individuals and families go without needed goods and services, merely because there is a shortage of money to catalyse the required productive processes.
Hello, dear. Looks like you're having a tough start to your day.
Hey, Grandpa. I just can't seem to concentrate after graduation and my new job starting soon. And I need a more reliable car to get there. And most places that I tried out for loans are just not willing to help.
Well, it's been quite a while since I first started out. It was hard finding people willing to take a chance on me as well. Luckily, through my company, I was eligible to join the Federal Credit Union.
Wait, what is that? A lot of my friends talk about Federal Credit Union, but I don't understand what it is. What makes credit union different from other places?
Unlike other types of financial institutions, the Federal Credit Union is a cooperative. Just like we're all working together here today, at the Federal Credit Union, people pool their collective resources to help the members achieve their financial goals. Look at it this way. One member's savings deposit is another member's loan.
But it's really hard to find someone that I can trust and not feel taken advantage of.
That's what's so great about credit unions. They only have to answer to their members. The control lies with you. And with the Federal Credit Union, as a member, you own part of the credit union.
Wait, what do you mean I own a part of the credit union?
Each person that joins the Federal Credit Union becomes a part owner. Every member gets voting power to elect a volunteer board of directors that controls the direction of the credit union. This helps ensure that the credit union is acting in the best interest of its members.
Okay, good advice, Grandpa. And look, if they can help me find a better car, you get the first ride.
Now that sounds like a deal. Now maybe you can help me with this contraption.
I think I can do that.
And I'll help you with yours.
Credit unions serve millions of people nationwide. The main purpose of a federal credit union is to provide you with access to affordable financial products and a safe place to access and save your money.
Hey, Grandpa.
Hey, right on time. Your new wheels look great.
Yeah, I just want to say thank you for your advice and the help from my local Federal Credit Union.
I'm so glad everything paid off for you.
Yeah, but I have a surprise for you. Headphones for your new cell phone.
Oh, thank you.
I figure you only turned 80 once, and I just wanted to say thank you.
Oh, you're so welcome.
To learn more about how credit unions can help your financial life, visit mycreditunion.gov. For more than 100 years, credit unions have provided financial services to their members in the United States. But what is their history? How did they get started? And what is NCUA? Before the mid-1800s, bank loans were a dream for most Americans. Unless someone guaranteed repayment, banks refused most loan requests. If misfortune struck, farmers and small businesses often went under with no hope of receiving even a modest loan to recover. The credit union movement grew from a simple idea. By pooling their savings and making loans to neighbors and coworkers, people could achieve a better standard of living for themselves and others. The credit union movement began in Germany. In 1848, Hermann Schulze Delitzsch set up a credit society to serve shopkeepers and other urban workers who had been forced to pay very high interest rates charged by local loan sharks. In 1864, Friedrich Wilhelm Raiffeisen organized a similar cooperative for farmers. These early credit unions became the model for today's credit unions in the United States. The key principles of the movement were volunteerism, self-help, One member, one vote, consideration of a person's character as well as net worth. Alphonse Desjardins, a Canadian journalist, proved instrumental in bringing the movement to the United States. In 1909, Mr. Desjardins and Pierre Jay, the Massachusetts Commissioner of Banks, played key roles in getting the first law for organizing credit unions enacted in Massachusetts. They also helped organize the first credit union in the United States, St. Mary's Cooperative Credit Association in Manchester, New Hampshire. Edward Filene, who many consider the father of U.S. credit unions, and his colleague, Roy Bergengren, a poverty lawyer, became convinced cooperative credit could work in the United States, a belief that was reinforced in a subsequent meeting with Alphonse Desjardins. Together, Mr. Filene and Mr. Bergengren advanced legislation to issue credit union charters in states across the country. In 1921, they also organized the Credit Union National Extension Bureau. The Bureau's main goals were to enact credit union laws, form new credit unions, and promote the general philosophy of credit unions. Through the 1920s, credit unions provided a source of inexpensive credit to purchase products like automobiles and washing machines. The popularity of credit unions grew because commercial banks and savings institutions generally showed limited interest in offering such consumer loans. By 1930, 32 states had adopted credit union laws with a total of 1,100 credit unions. In the aftermath of the start of the Great Depression, the time had come to create federal credit unions. In 1934, President Franklin Delano Roosevelt signed the Federal Credit Union Act into law, authorizing the formation of federally chartered credit unions in all states.
It means, I am sure, that the masses of the people of the nation firmly believe that there is great and actual possibility in an orderly recovery through a well-conceived and actively directed plan of action.
The purpose of the federal law was to make credit available and promote thrift through a national system of nonprofit cooperative credit unions. The Federal Credit Union Section was also formed, creating a national system to charter and supervise federal credit unions. The Credit Union Section was first housed at the Farm Credit Administration until it was transferred to the Department of Agriculture in 1939. The Credit Union Section remained a part of the Department of Agriculture until May 1942, when the first War Powers Act was used to transfer the section to the Federal Deposit Insurance Corporation. As the credit union industry grew, the agency moved from the Federal Deposit Insurance Corporation to the Federal Security Agency, and then finally the Department of Health, Education, and Welfare. After 36 years of moving the regulatory function from one agency to another, Congress created the National Credit Union Administration on March 10, 1970, as an independent agency. In 1978, Congress passed a law to create the three-member board that governs NCUA today. The National Credit Union Share Insurance Fund was also formed on October 19, 1970, to insure credit union deposits. In the independent credit union spirit, the Share Insurance Fund was created without tax dollars and capitalized solely by credit unions. Today, the Share Insurance Fund protects individual accounts up to $250,000 at all federal credit unions and the overwhelming majority of state-chartered credit unions. No member has ever lost a penny of insured deposits at a federally insured credit union. The 90s brought a strong economic climate, causing federally insured credit union membership to flourish. In 1998, President Bill Clinton signed legislation restoring expansion privileges and providing for multiple common bond credit unions, which allowed credit unions to increase fields of membership and mergers. In the years since the passage of the Federal Credit Union Act, credit unions have worked to offer loans and provide needed financial services to hardworking Americans. Today, federally insured credit unions have more than $1 trillion in assets and more than 100 million members. NCUA and its more than 1,000 employees continue to work to protect and enhance a credit union system that is safe, sound, and secure.